Hi guys, we've been talking about annuity, fixed annuity, and a mutual fund, but we have to keep that in mind that fundamentally we are, comparing apples and oranges, okay? Because mutual fund is basically is considered a security. Security means that your major objective, your major goal is to capital appreciation or capital gain. Okay, fixed income security like annuities, they're mostly getting the interest. Okay, so they're totally different objective, different investment goals. So we keep that with that in mind. Here is one thing, one comparison of two things that is making more sense. That is compare the annuity with the bond. Okay, so here is the question. Here is a very interesting question, that $1 million question, $1 billion question for all the retirees. Okay, how come? What is the secret for the annuity? To be guarantee you that you'll never outlive your income. So that put a different way means that there will always annuity payment waiting for you, no matter how old you will be. You live in 90, you live in 95, 100, and centenarians. The insurance company, they said that we can always pay you the money. So it's very much like your salary, your wage. When you work before age 65, each month or every 2 months you get a salary, right? So the annuity will do the same. So it makes no difference. It's like somebody's paying your salary. The difference is that this time after age 65, insurance carriers, they will pay you the money. Okay, but how? We know that in the employment years, the company may bankrupt it, and then people may get laid off. How the insurance company can be so sure that they will pay you to make sure that you never outlive your income, meaning the annuity. So what's the secret weapon? You would say, there are two things there's two weapons we mentioned. The first time we said is the deferred tax. That still holds. Remember, it's still important. It still matters because you don't pay your interest when you are doing the annuity. As long as you're putting the money, as long as you are adding water into the bathtub, during the entire process when you are adding water into the bathtub, the IRS will never bother you. Okay, the Angerson will never ask for a penny from you. However, when you start taking a shower, taking a bath, using the water in the bathtub, and then the IRS will after you. So what is the secret? That's one thing, is that especially like over 20 years, the longer the time, the better. Over the longer time period, the deferred tax money will be compounding. Money leads to money. So that helps. But there's an even more important, the so-called secret weapon when it comes to annuity. And that is something called mortality credit. Or you can call it I like to call it longevity credit. That means that that's something unique. Only insurance company can do that. Not banks, not CDs, not bond. Okay, because the secret is this: the insurance company, they gather a bunch of people. They say, "Hey, let's come to buy the annuity." So all the people buying the annuity, they put the money, let's say $100,000, okay? They put $100,000, and then, let's say, starting from age 65. Okay, each person put into 100 grand, starting from age 65. So let's say, 20 years later, the people reach the age of 85. Then what happened during these 20 years? Again, remember the bathtub. You keep water. You get let's say in this time we got a big amount of money. Let's say 100 grand into the annuity. So instead of turning your tap water and then let water slowly filling out the bathtub, no, we just we have big, huge container of waters, and then we just throw it into the bathtub, so the bathtub is full. Okay, just one shot. We got a single premium payment. Okay, so but it doesn't matter. Let's compare the bond and the annuity. So in terms of a bond, let's say 100 grand. Okay, there's one strategy called bond ladder. It sounds like scary, but actually it's easy. You have like 100 grand, and then 20 years, you buy a bunch of a bond. Not just one bond, but you buy a bunch of bonds. So let's say 20 years, you got 20 years, 20 bond. Each year, we will always a bond mature, meaning that the insurance company or the bank, the financial institute will pay you the principal as well as the interest. So that's how we call it a bond ladder, because it's not just a single bond, but a 20 bond. Okay, each year we have one bond mature, and then you get one. So you divide it basically 100 grand divided by 20. So that's kind of each bond is what? It's what, like $50,000, right? So that way, each year we will have, because assume that 3% the interest rate, 3% out of the 100 grand. That's basically $3,000 each year, $3,000 each year. So the strategy, ideally, that the investors who bought doing the bond laddering, they can live each year for $3,000. That interest rate alone, we can leave the principal untouched. But that's unrealistic, right? Because nobody can live for 3,000 years, $3,000 1 year. So inevitably, you have to not only spend like $3,000 interest rate, but you also get into principal. You have to dip into take some money out of the principal. So after 20 years, your principal and your interest rate payment will be mostly gone, because you spend each year you spend part of the principal, but also part of the interest, all the interest, right? So that's the problem with using the bond ladder strategy. It won't be enough, and the money will be gone after 20 years. So that's a bad strategy. Let's compare the annuity. Annuity is a different story, right? You buy the annuity, but the problem is that you contribute money to the insurance carriers. Insurance carriers, they gather a lot of money from different investors or the insured, like the policies, right? So here is what the secret weapon. What is the so-called longevity or mortality credit? Because let's say 100,000 people buy the same annuity, fixed rate, right? The problem is that 100,000 people, they die at different time. Some people lived let's say 5 years later, after age 65, some people died, and then some people died, after 20 years, 25 years. So basically, the basic idea is that the people who died earlier are providing subsidies to the people who live longer. So you may say that's not fair, but not life is not fair, right? What is fair is that we don't know. The insurance company won't say that you live you can only live 5 years. The other guy, can live like 20 years, 25 years, 30 years. That will be discrimination, right? That's not the case because it's all determined by chance. In the end, we all die. That's one thing. One thing that different separate life insurance and P&C. Basically, the way to remember P&C insurance is that home and auto. So if a home and auto, you may not have accident. But for life insurance, it's a certainty. Everybody dies. So we know that for sure. However, the big uncertainty is that we die at different time. We don't know when we die. Somebody may be hit by a car and then died earlier. Sometimes we see the sad story that the son and daughter died actually like 35 years old, and the son actually died before the 65-year-old parent. So a lot of uncertainty. In the end, we all die. That's a certainty. But when to die, that's a uncertainty. So that's why we have the insurance company to take advantage of involuntary subsidies, so to make sure that some people, they can always pay the money for everybody who live long enough. They can guarantee that because people live different life. So you might want to say, okay, that's one thing, and one thing is that fair. I think it's fair because it's determined by chance when you die, right? The second thing is that what about the modern trend? Because as time goes on, the trend is live longer. We all live longer, right? So 50 years ago, some 65 years old could be, his or her life expectancy could be like 15 years, like 75 years die, right? But today maybe 20 years. So that is true. But the thing to deal with that is that, remember we have annuity has two weapons. One is the interest rate, right? Another is the mortality credit. Interest rate still matters. We say that in the when you buy the annuity, the actuarial will do the calculation based on your habit, based on your lifestyle, based on your height and weight, and then those kind of things. And they take that into account, so they will, get an expected deaths for you, life expectancy for you. But the life expectancy is increasing, so to that extent, we will two things. Number one, we will charge a higher premium, okay, for all the annuity buyers. Number two is that we will depend a little bit more on the interest rate. Remember the interest rate compounding. So the two things combined gives that's why the insurance company can guarantee you that your money you'll never outlive your money. So let's stop here.